What's up, lads? Today we're cutting through the crypto noise and answering one question. Should Ethereum be in your portfolio? If you've been watching from the sidelines while crypto evolved from internet magic money to financial infrastructure, this one's for you. I'll show you how Ethereum works, why it's different from Bitcoin, and why serious investors treat ETH like a blue-chip asset. More videos will be made on this topic in the future. Make sure to subscribe so you do not miss them. Ethereum isn't just a coin. It's a platform, a programmable layer of the internet. Think of it as a global supercomputer that lets developers build apps with no banks, brokers, or middlemen. Bitcoin is like digital gold. You store value. Ethereum is the infrastructure. You do things with it. Say you want to borrow $10,000, no bank. On Ethereum, protocols like Aave let you deposit ETH as collateral and borrow stablecoins instantly. No forms, no credit check, just code. And every transaction burns a bit of ETH, giving the token real utility. Unlike Bitcoin, ETH doesn't have a 21 million cap, but that doesn't mean it inflates endlessly. Since the 2022 merge, Ethereum can go deflationary. Thanks to EIP 1559, part of every transaction fee gets burned, permanently. So even while ETH is issued to stakers, when network activity is high, more ETH is burned than created. That's right, a shrinking supply. It's like if the Federal Reserve printed dollars while burning old ones even faster. Ethereum runs on proof of stake, no mining anymore. Instead, people stake ETH to help secure the network. In return, they earn a yield, about 3.5% to 4.5% APY. To run your own validator, you need 32 ETH, around $90,000. But most people use platforms like Lido, Rocket Pool, or exchanges. You're earning Ether, not dollars. If ETH appreciates, your yield compounds, stacking sats, but Ethereum style. Is that 4% worth it, compared to fiat savings? Maybe. But with ETH staking, you're earning yield on an asset that powers thousands of applications, can go deflationary, still has long-term upside. If you're bullish on Ethereum, staking turns it into a compounding machine. Let's make this real. Imagine Airbnb without Airbnb. You want to rent a beach house. You send ETH to a smart contract. The contract holds the money and releases it to the host after check-in. No company, no fees, just code. Projects like dTravel already do this. Ethereum is the back end. You're not just buying a coin, you're buying the rails of a new internet. Let's follow the money. Emma wants that beach house. She converts dollars to ETH, pays the smart contract. The contract pays the host. The host converts back to fiat. ETH is the trust layer. It connects two strangers in different countries, with no one in the middle. Another example, decentralized insurance. Let's say your flight is delayed. You bought coverage on Etherisk, built on Ethereum. If your flight's late by 2 hours, a smart contract checks the data and pays you automatically. No claims, no waiting, no customer service purgatory. Ethereum is no longer a science experiment. It's financial infrastructure. It pays yield. It can be deflationary. And it's rapidly becoming the base layer for stablecoins, asset tokenization, and even on-chain corporate treasuries. Some companies are already running like crypto-native ETFs, accumulating ETH, issuing shares, and growing NAV per share by monetizing volatility. That's not theory. It's already happening. If stablecoins are the killer app of crypto, Ethereum is the protocol they're built on. So if you believe in a digital, decentralized financial future, Ethereum isn't just part of the story. It is the infrastructure. Next episode, I'll break down my own ETH strategy and how I compare it to Bitcoin. Be industrious, brothers. Are you ready to join us on this journey? Are you ready to win? If you're enjoying this content, show some love, hit the like button, and give it a thumbs up.